Sure.
So let us understand this mechanism. Section 17, which talks about blocking your input tax credit. Blocking input tax credit. This particular blocking of input tax credit happens this way. Law mentions that, look, primarily if you have other than business. What do you mean by other than business? Sir, I use it for personal consumption. So I give it for charity. I give it for Gupt Dan, something like that, which is other than business. Business, they have given a definition when there is a commerce, trade, occasion, which happens maybe on regular basis, may not be on regular basis. Second, I block your input tax credit if it is used exclusively for exempted or nil rated goods and services. Then you have specific block credit. What is that specific block credit? We have understood under section 17, subsection 5, clause A, then B, then C, D. We have studied like works contract, employee food and beverage, outdoor catering, beauty treatment, health treatment, hiring of a motor vehicle. All those things are specified block credits. Then if anything of these three are there, this will be out of your input tax credit. This will be out of your total input tax credit. This they call as T4. So here, to summarize, if you happen to visualize this diagram, this particular diagram happens to be my total input tax credit. Out of this total input tax credit, there is some portion which is called as T1, which is your other than business. That I should not avail. There is some portion which is exempted, T2, that also should not be eligible. There is some portion which is defined as a block credit, T3, even that is not eligible. Now there is some specific credit which I'm eligible. They're saying that go ahead and claim this in electronic credit ledger. Claim this input tax credit T4 in your electronic credit ledger. I'll just show you the Excel file which I've shared the other day. Is the Excel file visible, Shiv?
Yes, sir. It's visible.
Yes, sir.
So they have asked you to identify like this. Let T be your total input tax credit. Out of that, there is some input tax credit which they call other than business. I don't use it for business. The moment you purchase, you get that this is not meant for business. Then they eliminate that from your input tax credit. Then you have second category called exempt supplies. Because exempted, you are not going to pay any GST to the government. There's no value addition from the taxation point of view. They say don't claim that input tax credit. Then they have specific category called block credit. That particular block credit, they say, please remove from your total ITC. So you'll get a common credit or a specific credit called C1, input tax, which gets credited to credit ledger. After eliminating this T1, they say remove T1, remove T2, remove T3. Then you have something called T4, which is specific and which is called common. Government says that, let me call this as C1. Government says that let C1 and T4 be credited to electronic credit ledger. Let that travel. Out of that, they say T4, which is specific. I'm not going to question you. Enjoy the credit. I'm not going to ask you anything. The remaining portion, they say C2 is your C1 minus T4. So my specific credit, they have, okay, let me call this as C2. This entire C2 is equal to, they say C2 is equal to your C1 minus T4. C1 is nothing but total credit minus T1, T2, T3. They have defined here. My C1 is equal to total credit T, out of that T1, T2, T3 if you remove. That is how they have defined. So government said that let this specific be credited. Let this common also be credited. This particular common credit is something where your Rule 42 comes into picture for identifying how do I reverse. They say that when you identify this common credit C2, they are saying that, look, this consists of any other than business. Other than business, if you have used this common credit, declare 5% as ineligible. They have called D2 is equal to C2 into 5%. Now, this is the formula. So, why 5%? Why not 10%? Why not 15%? Law has said 5%, 5%. I don't have any question on this. Blindly, I have to say this is 5%. Now, other than this business, suppose C2 is used for both taxable and exempted. So they say that this you will identify like this. D1 is equal to E divided by F into C2. This is what they have mentioned. E divided by F into C2. Now, E is your exempted turnover. E is your exempted turnover. F is your total turnover. F is your total turnover. This is what law has defined. Let me just come back to Excel file. They say that use this proportionate formula E by F into C2. E by F into C2. E is your aggregate value of exempt supply. F is your turnover in the state, total turnover in the state. So they're just going with a mathematical equation saying that if your total turnover, I'll just come back to the Word document. They're saying that if your exempted turnover, when you look at this diagram, if your exempted turnover, say this block credit, no, T2 is your exempted. Input tax credit intended to be used other than, exclusively intended for exempt supply. Yes. So this T2 is what they're trying to identify. They are saying that whatever exempt portion is there. So this out of total population, they are trying to identify. This is what the mathematical formula they are trying to give. Your exempted credit is your exempted turnover divided by total turnover into the common credit. So this E by F is going to give you a percentage. E by F is going to give you a percentage. This percentage I'm going to apply on my common credits. Now this I have to do for SGST, CGST, IGST. This is what law is expecting. If you have union territory tax, central GST, integrated tax. This is what law is expecting us to do, applying Rule 42. So government says that, look, the moment you have received the credits, this entire population, they have called as T. Out of T, this T4 and C2 straight away comes to credit ledger. Now, when it comes to credit ledger, there's a portion called C2, which is also enjoyed. So government said that do this on a monthly basis. They said that step 1, apply C1, C2, D1 on monthly basis. Every month, Identify your ineligible credit. Then step 2, rework step 1 on annual basis. That means to say, month on month, whatever ratios you have, you apply that. Do it for 12 months together. Reason, pattern. Like I was giving one the example the other day. When we look at month 1, month 2, month 3, so on till month 10, 11, 12, I could have purchases, I could have sales. Purchases happen in month 1, month 2, sales happen in month 3. Similarly, purchases happen in month 10, sales may happen in month 11. Purchases again happen, sales are subsequent. So because there is a erratic pattern, this erratic pattern, they want to rework on annual basis at the end of year. This is what they have said. Now, step 3. Step 1 minus step 2. The output could be output 1. I could have done higher reversal or output 2 short reversal. Output 3, no short, no excess. Possibility is there. Ideally, theoretically, it will happen, but practically, it may not happen. How it may happen? So there is only one customer. Every month, I bill 10 lakhs to this export, 5 lakhs to this domestic. Other than that, there is no difference. So every month, if I like the rental income, every month, if I bill, there is no erratic turnover, then that output 3, no impact will come. Theoretically, it may happen. So if I have higher reversal, then output 1, they say that claim back this excess reversal before September. If you cross September, gone. Your benefit of excess reversal is gone. Output 2, short reversal. Whatever you have reversed short, they say reverse with interest computed from April. Computed from April onwards. If you have did a short reversal, like doing this, say in step 1, I have reversed, say 100 rupees. But step 2 says I should have reversed 120. The balance 20, I have to reverse. So from assuming, now when do I reverse? My GSTR 3B, GSTR 3B for April. Let's assume that financial year 24-25. My 24-25, this excess, whatever to be reversed, 3B for April 25, I would be filing my April 25 return. I'll file on 20th May 2025. So the government says that from 1st April 2025 till 20th April 2025, whatever gap is there, for this gap, pay interest. Pay interest. Now, this, if I consider in April, this 1 month, 1.5 month. If I consider in September, 6 months interest I have to pay. So this government is getting a extra laddu, saying that you're reversing, I admire, but you pay interest also. Why? Since you have enjoyed, you pay interest. So by default, that 1 month, 30 days plus 20, 50 days interest is by default, it will happen. Now, if I want to save my interest, what I can do? I can pay through DRC03, pay through DRC03 on 1st April itself. 1st April 2025 itself, you try to pay this particular money so that you can save your interest. This is what law is expecting from your section 17. Are we clear? Shiv and Mohan, any doubts before we go further?
No, Pradeep.
Okay. Now.
Small doubt.
Yes, sir.
Already have definitions of T1, T2, T3, everything.
Correct.
Within the common ledger, there is a possibility that there will be some more credit which is not
this C2 you're saying. C2 you're saying, right? This one. So let's assume this way. Now there are services, there are goods which are common to business. Like example, a building on rental basis. Now this picture, no, your entire credit is credited to this. Now that input service called security service, can I put into T1?
Yes, but if it is proportional,
Ah.
the cost of the building cost.
Ah.
That's
Now
very
security is for common for entire building.
different.
1, 2, 3, 4 office is there. Now I cannot identify for other than business. So it is not in T1. Can I call T2? It is not exempted. Can I call T3? It is not block credit.
Yes.
So can I say T4? Sir, no, sir. It is used for both taxable and exempted.
Exempted.
So that security service comes and sits in C2. So that goes and sits in your credit ledger. That is what we are putting efforts to identify. So law has actually said this. In reality, we don't go with this technique. What we do, we straight away, at purchase level itself, in reality, what we do, your total input tax credit, whatever is there, I identify T1 and I'll say, I'm not going to take credit. I identify T2, which is your exempt. I try to disallow my input tax credit. I identify block credit. This is block. This is exempted. Even this also I will not claim. Then instead of doing T4, I try to identify C1. C1 is T4 minus. That C1 I'll try to identify. How do I identify this common credit? Based on security, audit fee, advertisement, rent. Since I know, we try to identify these common credits and straight away I apply this formula E by F into C2. This we do on a real-time basis. Instead of identifying T4, identify that from C1, then travel to C2. Instead of doing that, we do this straight away every month. Clear na, sir? Now, this is what we have done till now with respect to input and input services. Now, is this mandatory? Answer is mandatory. Sir, I'm a small-time businessman. I operate, let's take the very, very basic example. Take example, this milk parlor business. Will he have turnover more than 20 lakhs? Answer is definitely yes. Now, when I say turnover includes taxable exempt supply. Milk, curd, say it is exempted. This ghee, biscuits, buttermilk, those are taxable. Eventually, I cross 20 lakhs without doing any efforts. A small shop fellow. Now, for that particular shop fellow, when you buy this Britannia biscuits or this, the bread and other thing, those are taxable at the rate of 5%. Now, I'll say, sir, on an average, I buy 2 lakhs. On 2 lakhs, 5%. Sir, why to leave 10,000? Sir, my rent itself is 10,000. So they're careful for the 10,000. Now, when I talk about that particular business model, I pay rent. I pay the audit accounting fee. Now, those services which are specific, which are common, now those credits I want to do, then I have to apply Rule 40. Now, a small time business or big time business, when your business is exempt and taxable, I don't have a choice. I have to do this eventually. So if I know the formula, how it will work, then I can do. So what I need to do, first I need to know business. Like we call KYC. If you don't know your customer, if you don't know the business, how do you guide them saying that this is what the law is? Second, you should know accounting principles. Like right at the accounting stage, I'll say exempt, I'll say taxable. Now we have something called cost center. In Tally, we have this feature called cost center. So when I put into this cost center, exempted, non-exempted. So while using, like we define something called voucher series. So using that voucher series, we bring in a control. You're bringing this milk and other things which are exempted. Use this E1, E2, E3 series, voucher series. If you're using it for taxable, T1, T2, T3 series, I define my accounting vouchers, defining process itself. This is what we call as your chart of accounts. In our accounts, we have this chart of accounts. They'll say, why you should know your chart of accounts? The reason I should know my chart of accounts is I define my business process, accounting process, when I know my business. This is where, our CA curriculum or cost accountancy curriculum, we have auditing, accounting, taxation, law. Without accounting, accounting is a basic principle. I should be very strong and keen in my accounting. I set my accounting process. Auditing. When I audit, I should know what am I auditing. Taxation. How does the taxation work? Your income exempted, your income taxable. Your income, input tax credit, not input tax credit. I should know where to put this accounting entry. Finally, legal. How do I apply these aspects for better disclosure? This is where that four pillars of our curriculum helps us to become a complete chartered accountant or cost accountant. This is with respect to your inputs and input services. Before I move into capital goods, let's take example of motor car. Then say plant and machinery. Motor car, plant and machinery, when I say, looks like a fixed asset, but maybe a current asset based on my business model. Ideally, motor car is a capital goods, fixed assets. Plant and machinery, capital goods, fixed assets. It can also be a current asset when I'm doing a trading activity. Correct? Now let's see, assume Ravindo Toyota car dealer showroom, or say there is a Maruti dealer. For business, when I buy a car, for me it's a fixed asset. I call capital goods. For the Toyota showroom, the dealer, that's a current asset. I buy and I sell. Now, depending on this, I classify my capital goods also. This is where your identification starts. This is where basic preamble I need to know to whom I'm doing my accounting, where this rule 42 or rule 43 comes into picture. Now, rule 43 talks about ITC on capital goods. This is little straightforward, not that complicated, but when lawmaker wrote this law, he made it complicated. When we speak, it's easy. When I write, it becomes so complicated because I have to explain. If that is there, do this. If this is there, do this. If this three are not there, do this. Now reading that if and but, semicolon, comma, and or becomes complicated. Rule 43 says that, look, I'll call category A where my capital goods are exclusively other than business or for exempted goods. Exempted goods. I call category A as capital goods, which are exclusively used other than business or for exempted goods. Can I claim input tax credit? Answer is no ITC. Then category B, capital goods which are exclusively used for taxable and zero rated supply. This you can claim input tax credit, though there is no restriction. Whatever plant and machinery, whatever fixed assets you buy, claim your input tax credit. Now, when I say claim your input tax credit, subject to section 17(5). It should not be a block credit. Like example, sir, I purchase a motor vehicle. I use this motor vehicle for pickup and drop of employees. The seating capacity is less than 13. Though I am into manufacturing activity, though I am paying tax, there's a concept called block credit. Don't take input tax credit on those motor vehicles. So subject to 17(5), you can claim. The left out category C, other than A or B. Other than A or B. That means to say, the capital goods which are not specific for exempted, the capital goods which are not specific for taxable. This is what I call as category C. Now, to give an example, let's assume that there's a factory. I manufacture taxable or zero rated supply. I manufacture exempted goods also. Now, assuming that there is a measurement apparatus, like we call calibration tools. Calibration tools. Now, each calibration tool is worth around, say, 5 lakhs. Precision. This has a very good precision. These calibration tools I use both in taxable, I also use in my exempted activity. Like when a customer, I give it to defense, DRDO, exempted. I manufacture and sell in the local market, taxable. I export, zero rated supply. But before these goods are given, I need to give a test certificate, which is a quality certificate. Means what is a precision? Let's assume that this is a tool which has a tip. Now, this tip should have, say, 6 mm positioning. Way they say, when I have a cylindrical position, at this position, it should have so-and-so curvature. Now, these are all technical features which are relevant for me in a particular business. Now, this measurement I can do with a technical apparatus. That apparatus is common between this and that, which fits into clause C. Now, government says that, look, whatever is there in category C, let this be credited to electronic credit ledger. Go ahead and claim input tax credit because it's common for both taxable and exempted. Now, on this C, element of ineligible, that is say D1, is your E divided by F into C. E is your exempted turnover, F is your total turnover, C is your common credits. This is what they are trying to mention. Very, very simple so far. Any doubts? A, not eligible, don't take. B is specific eligible, take. C is a common fixed assets. Now you apply this formula. Exempted turnover divided by total turnover into common credits. But if it is so simple, you wouldn't have come for these classes. Somewhere complexity should be there, no? Law says that, look, life of a fixed asset, the capital goods, is 60 months. 60 months. So they say that, now they have given TM, TR, TE. Now the definitions, no, they have used. I'll not come into that specific definition. We'll understand the concept. They say that life of a capital goods is 60 months. So whatever you have identified, see, let no every month, if you want to reverse your input tax credit, first they say, let this common credit be called as TC. The total input tax credit on capital goods, which is common for taxable and exempted. That TC divided by 60, I'll get TM. That means monthly input tax credit on capital goods, which is common. Which is common. So the law says that, look, first you enjoy the credit. Don't wait, because there is a time limit. You take the credit. It's like, no, person who has a habit of drinking, person who has a habit of borrowing money, person who gives that lending business, take it. The moment he takes money, he is going to get benefit. A pawnbroker. Similarly, government, don't worry, take it. The moment they take, when reversal starts, no, reversal will not be simple reversal. Reversal with interest. So government is getting that what you call passive income by way of your interest. So every month when you do this formula, this exempt turnover divided by taxable turnover into common credit, this TC is nothing but that TM. Every month what I get now. So I need to do this every month and TM into E divided by F. This is your ineligible for a tax period. For a tax period. This reversal with interest. So why interest? Reason, you took the entire credit in day one. After 1 month, after 12 months, after 30 months, you're reversing that interest. Because you have enjoyed that point in time, you pay with interest. To save that interest, can I say, sir, I'll take only that TM every month? Now, accountant will run away. Saying that, assuming you have, look at the pattern, like month 1, month 2, month 3, so on till month 12. I have 5 assets, I have 4 assets, 2 assets, 1 asset, 9 assets. Now, every month he has to open a Excel sheet, spreadsheet. Keep on date of capitalization, date of invoice, date of that 60 months which is getting to over. In this month, so much of credit which needs to be brought in. Says, sir, hell with your, what you get is that peanuts. You are, you're craving for that peanuts. You take from my salary. That fellow will say, because he's not capable to keep a track of this. So instead of doing that, they say, you take everything in one go. Only thing, keep the track of your total credits. Now, this TM1, TM2, money, whatever you have now, sorry, this common credits, TC. Whatever common credits are there, TC, all this together, they call as your total credit called TR, which is supposed to be reversed on a periodical basis. This is how they say you identify the TC, every asset wise, put it to TR divided by 60, again you will get back TM. Like when I put that MCR, we may get confused. Just keep in mind. Concept is that first you identify the common credit. That common credit divided by 60, I'll get per month. So whatever this individual asset wise are there, put into one common kitty called TR. That TR divided by 60 is where I get my TM, monthly reversal. TR is your result. TC is common credits. Common credits for each asset put into one common account called TR, which is a total running account. From running account divided by 60 per month, I am going to get my ineligible credits. Ideally, this is what to be done. But what we do is we reverse this instead of TM in reality, in practicality. Total whatever credit is there now, this TC divide into E by F. My total credit, instead of doing that monthly M1, M2, month till 60, my total credit, I do this reversal E divided by F. When we did this, it's a bulk amount. Instead of that small, like 60,000 divided by 60, I get 1,000 per month. Instead of doing 1,000 reversal, straight away in one go, I have reversed 60,000. We anticipated that when we do this, the GST officer is going to ask us to recalculate this for 60 months. There was an audit which took place. He did for 12 months. Then he said, Sachodo, this is hardly 200, 300 is coming. Doing this E by F. No, assessor said, I'll not do anything. I'll give you my financials. I'll give you the turnover. You do it yourself. I have this pattern. This pattern, month 1, month 2, so on, I have to keep a track. I don't have so much of patience. Straight away, I'll do this. If you're okay, you take it. If you're not okay, you do the calculation. So officers, first and foremost, they don't know this formula. The gentleman who knows this formula, Somberi, they don't do this calculation. They ask the accountant to do it. The accountant does where that 12 rupees, 15 rupees will come. He'll say, what will I do that with 15 rupees? If I say 15 rupees, commissioner will shout on me. So he'll also drop that particular point. Law is expecting me to do this mechanism. Are we clear before we go further? Any doubts?
Sir, one interest accumulation, interest payable, this thing, while reversal,
Little louder.
is on and off.
Interest payable.
Sorry? Get
Yes,
my
Mohan,
point?
you're saying. Yes, Mohan.
Am I audible?
Yeah.
Yes, sir. Sir, when the reversal occurs, no, this will happen only when we are selling the goods or removing the asset from the books.
When reversal happens?
The reversal may happen on sale of the fixed assets, such a situation, right?
Huh.
Though interest is fundamental to charges at that time.
Because see, you have enjoyed that credit in the month which you have purchased. Because you are
Yes.
reversing after 5 months, 10 months, the ineligible credit, government is saying that so much of ineligible is there, which you have enjoyed in month one, you pay with interest.
Okay, only the not used the 60 months. For example, if you used 20 months, balance
come
40
back.
months alone, we have no. Yes, sir.
I need not
That,
pay more. I'll explain that.
yes, sir.
Question of more is, let's assume that month one, there was a capital goods which was purchased. Ideally, loss is that month one, month two, so on till month 58, month 59, month 60. This is a life. In between, say, month 40, where I decided to discard the asset. I want to discard the asset. Should I pay interest from month 41 till 60? Is this your question, Mohan?
Yes, sir, exactly.
So when I discard the asset, that point in time, section 18 comes into picture. Section 18 comes into picture saying that, look, I give you a life of 5 years, right? So when I say life 5 years, now you have used it for 40 months usage, 20 months is remaining. So identify proportionate ITC which is pertaining to this 20 months. How do I identify? You remember that 3 months, 5% per quarter. Now 20 months, 20 divided by 3, I'll get odd. So I have to identify the number of quarters where that 5% comes into picture. Law is asking me to find out this 5% proportionate credit pertaining to this 20 months. Ideally 18 months, 6 these are 18. Remaining that part of 1 month, I'll round it off. 18 months, I'll find out. This I'll call as, say, A. You are going to sell the asset. On sale, I have a transaction value. I call TD. On this, I'll apply the GST rate, 18%, whatever is there. The GST payable on this transaction value, I call as B. Now, when I compare A and B, A is at 10,000. That is the remaining GST proportionate value. On transaction value, I may get 12,000. This is scenario 1. Scenario 2, I get that proportionate 10,000 only, but I am going to sell where I am going to pay GST of 8,000. Law is saying that whichever is higher, pay the GST. Alva? This is the common law. So in this case, pay 12,000 GST. In this case, pay 10,000 GST. Since I am going to apply this proportionate rule, Mohan, at this point in time, whenever you have decided that you are going to discard, section 18 comes into play to say that, boss, whatever remaining life is there, identify and reverse this particular credit. When I have reversed on month 40, Mohan, the remaining, I'm not enjoying now. I'm not going to enjoy. So no need to pay interest on this particular remaining portion. Am I clear?
Yes.
So whatever you have enjoyed on month one, assuming you are going to sell, you're going to pay on this. Sir, I'll put it this way. Sir, I'm going to, let's say option B is not there, option C. I just discarded the asset as zero value. I retired the asset where the value of retirement is zero. Then whatever 10,000 is there, I'm going to reverse this 10,000 with interest till month 40. Month 1 to month 40. For this period, I'm going to pay interest more.
Okay. So in this case, sale value is lower. And in such case also the proportionate value.
Okay. I'll put it this way. This credit, now point number 1, is this a fixed assets, capital goods, which is common to taxable and exempted? Yes or no? If you say yes, if it is a common asset, then interest eventually I'll pay. till date of
Oh.
retirement, there's no excuse. If it is a
Okay.
fixed assets, which is common, interest till date of retirement or reversal, you have to pay.
Okay.
If it is pertaining to asset which is exclusive for taxable, no interest.
Clear.
That is what we have to do.
Clear, sir. Thank you.
Are we, no doubt so far? Complexity is little more. Like, why this complexity? Business is like that. It's not that law made that complexity. Now, the business means it's so complicated. What you will do now? I called category A, I've called category B. These are the two categories I've said. What is category A? Completely
Business.
other than,
Business.
remember, A is other than business, exempted. Exempted. B is exclusive for taxable, exclusive for zero rated. So here, A, I'm saying, Baba, don't take. B, I'm saying, you take. Correct, na? After, say, 6 months, business owner comes and says, sir, category A got converted to category C. What is category C? Common for both taxable and exempted. Or he'll say, so my category A got converted to category B. I have been using month 1 when I purchased, I was using for exempted. After 6 months, I started using for taxable. Now, this is where business works. There's one central government organization where we had this practical issue. When they started the business, they say, sir, we use only for defense. No, don't take the credit. When they're using for defense, there is a failure. They were not able to convince the client. Then the management decided, let's take out defense and let it put to the domestic market. Commercial, they're not specific that particular precision. So let's not use it for that. With the nature, earlier I was using exclusively for exempted, now became taxable. Or say I bought this to be used for exempted activity. After usage, I felt that I can use it for taxable also. So this is where my asset usage either becomes common or specific. Are we clear with this example? No confusion? Shiva and Mohan?
No.
No, sir.
So if things are simple, life will not be easy. No, we should have complexity, then only life will be thrilling. Alva? If everything is a plain vanilla, there is no big charm. People say, when we see the bad phase of life, then we realize the value of good phase of life. If days are all good, we don't know the value of goodness. So to know what is good, I should know what is bad. So bad and good are part of our elements. In Hindu culture, we have this Makara Sankranti, and we also have Ugadi. Ugadi festival, like when we make that pickle, we have that Ugadi pachadi. Like we have sweet, we have sour, we have bitterness, we have kara, we have that spicy. Part and parcel of we call Shedruchulu. This means we have all that 7 variants in our life. This is where this complexity gets built into the business. Now, let's understand this example in this manner. Month 1 till month 5, month 6 till month 60. Now, this is a phase where I've used exclusively for category A. The period month 1 to month 5, I've used only for exempted activity. Month 6 is where I started using this for taxable till month 60. This is scenario number 1. Scenario number 2, I have used this asset for this 5 months only for clause A. Month 6 onwards, it is, I'll say, this instead of T, I'll say clause B, which is your exempted. I may use it for clause C. So this is exclusive taxable. This is common for taxable and exempted. Category scenario 2. I use it for taxable, I use it for exempted. In scenario 1, I use exclusive for taxable. Now, in scenario 1, are we clear with both the scenario? Scenario 1, where 5 months usage is only for exempted. 6th month, I decided, sir, let me not use it for exempted, let me use for taxable. Like example of that DRDO, defense. 5 months I used, I failed to prove, I decided, let me not use in defense, let me use in domestic commercial market, which is used for exclusively taxable. So for scenario 1, section 18 will be applied. Section 18 will be applied where they say, you remember that 5% proportionate per quarter? ITC, apply this particular rule for initial 5 months. Find out eligible ITC. Transfer to credit ledger. Law says that, look, since 5 months, this 5 months you have used exclusively for non-taxable activity, apply that formula of that 5%. Now, like when I say 5% proportionate per quarter, 5 months will be rounded off to 6 months, 2 quarters. So whatever input tax credit is there, like assuming I have a credit of 1 lakh, or I'll say is of 1,20,000. 1,20,000 divided by that 60 months, 60 divided by 3, I get 20. I use 2 quarters for exempted. Whatever result is there, that is ineligible. Now to get eligible, what I'll do, 1,20,000 into 18 divided by 20. The result of this, I'll transfer to electronic credit ledger. Clear? Shiv and Mohan, are we clear?
Yes, sir.
Sir, yes.
Then this is scenario 1 where they say, because you have used 5 months, I'll disallow. The balance you credit to the credit ledger. Now, once I credit to the credit ledger, the usage is for category B, which is for taxable. From month 6 onwards, no need to pay interest because it's eligible. Government is not going to lose anything. You can enjoy that credit. Did I enjoy it in month 1? No, sir, I didn't enjoy it. I put it as ineligible. Because I became eligible, month 6, I'm going to take this credit. This is what loss is. Now, what happens? Sir, in scenario 2, like scenario 1, find out proportionate ITC for that 5 months. First 5 months. Result is your balance ITC for another 55 months. Right? This 55 months, I'll credit to electronic credit ledger. The money of input tax credit, which is resulting for the balance 55 months, I'll credit to my electronic credit ledger. Once I credit to my credit ledger, then I'll find out TM. TM is equal to the TR divided by 60. So whatever TM is going to come, I'll apply E by F into the TM. Every month, I need to find out what is my proportionate ineligible input tax credit. Pay that with interest. This is what I'll do for that balance 55 months ITC. 55 months ITC. This is what I'll do for scenario number 2. Now, theoretically, this is easy. what we have worked out. What we do is, you remember your fixed assets register, FAR, where in fixed assets register, I have category specific my asset list. When you do your depreciation calculation, each asset, line by line, I have assets. I do depreciation. I find out what is the residual value, what is the depreciation for that asset. Similar to your FA register, these capital goods where your rule 43 gets applied, I calculate what is every month, like this financial year. I plot in my asset list. I'll say year 1, year 2, year 3, year 4, year 5, year 5. Year 2, year 3, year 4, year 5. For these 5 years, I plot like how many months are there, and based on the months, I try to apply what is my TM every month. This TM, I'll apply this exempted turnover by total turnover every month. This I keep a track similar to my fixed assets register. Do you have any no choice? Answer is no. When the assets value are high, I don't have a choice. I have to follow this particular procedure. Small time business, we may not have this complexity. Big business, they have this complexity. This is what we need to keep in mind. Rule 43. Till now, this is your rule 43. If doubts, I'll clarify. If not, we'll go further. Real estate, this is little more complicated than what we are looking at here. We'll go further. Mohan and Shiv.
Yes, sir. We shall.
Yes.
No. I was talking about your exempted turnover. What is my exempted turnover? Where I have defined that section 2, clause 47 talks about what is your exempted turnover. In addition to this exempted turnover, I have given 3 categories. One is your transaction in security. Transaction in security is your exempted turnover. Second, sale of land, building. Third category, not reading after the class. At least glance through. There's a schedule 3, clause A for entry number 8. You remember that?
Duty free.
Duty free shop. Sale of goods from duty free shop in an international airport, right? So here, now we need to know the valuation. What is the value I have to take for exempted turnover? For the purpose of this exempted turnover under section 17, for the purpose of section 17, clause 2, subsection 2, they say my value of transaction security is nothing but 1% of sale of investments or investments. Whatever security you call, mutual funds you call, equity, the sale value, whatever is there, 1% of that sale value will be considered for the purpose of security. Assuming I sold securities worth 10 crore, I'll put 1%, whatever result value is there, 10 lakhs or 1 crore, that is my transaction value in security. I don't take the straight away 10 crore as my value for the purpose of E. You remember this D? D is equal to E divided by F. We are talking about this E, the numerator. The exempted turnover, when we say whatever exempted turnover as per section 2, clause 47, that becomes your numerator, exempted turnover. In addition to that, when I talk about transaction security, they say value is 1% of the sale of investment. Whatever sale value is there, 1% is deemed to be your exempted turnover. With respect to sale of land and building, value which I have used for paying municipal taxes. Value which I have used for municipal, not taxes, I'll say, for instead of municipal, registration, for property registration. The value which I have declared to the sub-register office for registration, that value I take into consideration for exempted turnover. Like example, sir, I bought a building which I paid to my the seller 40 lakh. I paid to the landlord 40 lakh, but the guidance value of that particular jurisdiction is 45 lakh. So I don't have a choice. Stamp duty I have to pay on 45 lakhs. Like, let's take example of Kolkata. In Kolkata, though I pay lower value, the guidance value which will be much, much higher than the guidance value. Never ever my transaction value will be equivalent to the guidance value. Those cases, they say, whatever value you have used for your registration, no, that should be the value. So what if my sub-register value is 45 lakhs, but I paid 50 lakhs? Then they take that 50 lakhs ideally. But they say value should be the value which is used for guidance, that is the registration value. At times, though the 50 lakhs is in, law says use that 50 lakh, that 45 lakh, you have to use that 45 lakh. Let me just show you that provision. Clause 2. For determining the value of exempted supply under Section 17, subsection 3, value of land and building shall be taken as same as adopted for the purpose of paying stamp duty. So they say that the value shall be that land and building same as adopted for the purpose of paying stamp duty. What if the stamp duty is on 45 lakhs, but actual consideration is 50 lakhs? Now, law says stamp duty, I can go with 45 lakhs. Examination, if they ask the question, we have to be careful. We will say, because the law says that paying stamp duty, I'll go with 45 lakhs. But if the officer demands that there is a value of 50 lakhs, law is supreme. Whatever is written in the law, I have to follow. I'll take the stamp duty value. In case of securities, they say value of security shall be taken as 1% of the sale value of such security. This is what they are talking about.
One small clarity.
Yes, sir.
You say, as allotted for the purpose of paying stamp duty.
Stamp duty.
If the clearance value is 45 lakhs, but the consideration is 50 lakhs, the registrar will ask for stamp duty of 50 lakhs only, not of 45 lakhs.
Logic is good. Where I have higher consideration, let's go with the 50 lakhs. There is no issue. Ideally, like, this investigation cases, yes. I pay 45 lakhs, then one more agreement where I'll pay 5 lakhs instead of paying directly 50 lakhs. Where I have offered 50 lakhs, guide at sub-register will say pay on 50 lakhs. Yes. Where they'll say I have paid 45 lakhs, balance 5 lakhs, I have a separate agreement, yes. Post sale, which is connected with this. Yes. Unearthed. Probably that point in time, 50 lakhs will be taken into consideration. Then, apart from this, there is Rule 44, Rule 43. There's one explanation under Rule 43. What is your exempted value? This is a little important. Examination, where we may have questions on this particular value for exempted turnover. Explanation 1, where they say, for the purpose of Rule 42 and Rule 43, hereby clarified that the aggregate value of exempt supplies shall exclude. Clause B, your interest income. Clause D, sale of duty credit scrips. This is where generally in examination we'll have questions, and also when we do this exempted turnover, we have general doubts. Clause B, Clause D. I'll explain this. When we prepare our financial statements, assuming that this is my P&L account. In P&L account, I have sale of taxable goods, sale of exempt goods, then I have other income. Ideally, whatever is the income which comes on the credit side of P&L account, this becomes your, in this formula, E divided by F. This is your F. To the extent of this exempt, this becomes D. If at all, this has got again taxable and exempt, this also becomes D. This is what we do. In this other income, generally I have, when I look at my other income in my P&L account, I may have interest on fixed deposits or savings account, or your interest income where I gave for lending, other lending, like the pawnbroker or common who does on a regular basis. Then you have sale of duty-free duty scripts. That duty script where we have one is your advance authorization, then we call invalidation, duty-free import authorization, or RODTEP script under customs. Now this comes from customs law. When I export, government gives me an incentive. This incentive could be by way of duty drawback, I call DBK, or script. This exports, this comes under Ministry of Commerce. Quite interesting. Government says that, look, I need exports. When exports happen, I get foreign currency into India. Now, to encourage these exports, I have to give lollipop to the business people. So they say that, look, when you export, I'll give you a duty drawback of 2% or 1%. That means I don't do anything. Straight away, this 2% or 1% comes to my bank account. You export, shipping bill is there. On that shipping bill, whatever FOB value is there, 1% of that comes into my bank account as duty drawback. There is nothing to be done. Then there is something called duty scrape, which is like your money, similar to money. I use this script for payment of duty. Now, government says that, look, in addition to duty drawback, I have a scheme, I have a mechanism. When you export goods to a particular country, when you export goods of a particular pattern, on those goods, I give a script which is like loaded, like currency. We call negotiable instruments, like your bank guarantee or bill. Like assuming I have sold goods to you. Instead of you making a payment, you draw a bill on me. I go to my vendor, I get it discounted with banker. Now this is the value, negotiable instruments. Something like that is your script. Script is also like a negotiable instrument. So they load 2% or 1% into the script and they give to your account. This script I can use for further import, or I can transfer to some importer who wanted to use that particular script. So this script generally we call as other income, which gets credited to my P&L as other income. Now, assuming I get a script for 100 rupees, I may sell for 100 rupees, but ideally what I do, I sell for 95 rupees. Reason, like, no, I want immediate cash. Someone who wants to buy Like, why should I buy? Like, I can pay 100 rupees from my pocket. If I'm buying script from me, oh, what is the valuation I'm going to get? So ideally, that 2% to 5% is a margin where they sell in an open market. So whatever sales price is it, that gets credited to my P&L account. Where do we find this duty script? If you ask, textile sector. Textile sector, predominantly we find this duty credit script which come into picture. Like all these manufacturers, no? They manufacture and export out of India because Indian products are cheaper. African countries and European countries, they buy textile products from India. After this Trump has come in picture, entire exports to US got stopped. Now that industry where they have textile, the moment they export, they get script. There is nothing which they import. If they import, my manufacture becomes costly. The shirt which I manufactured in India, I sell for 500 to 600. But the same shirt, if I export, I can fetch 1,000 rupees. So they procure in India, they manufacture in India, they export out of India. That particular business, I get this RODTEP script called this duty-free script. If I use it for my business, I call that as income. If I use it, if I sell to someone else, I call that as a no other income. So now the rate of GST on this script, duty script is exempted goods, or I would say exempted under GST. Because it is exempted under GST, Section 2, Clause 47 gets applied for this particular duty credit script. Because this is like an incentive, government said that, no, exclude this particular duty script from this particular numerator called exempted turnover. So as per Rule 43, there are two exclusions. There are two exclusions. What is that? One is your interest income, where I am into business of extending loans and advances. If I have given money on loan basis, I get my consideration by way of interest. That is not to be considered for Rule 42, 43. Similarly, second is your duty script. These two will not form part of, I'll say, not to form part of the numerator. That is D. When I apply this formula, E by F, when we say E by F, this exempted turnover will not have interest, will not have duty credit scripts. Examination, generally, this is one point which they test in our CMA curriculum. Exclusions rule 42, 43. Are we clear? We'll go further.
Yes.
Shiv?
Yes, sir.
Any duty credit script you have come across, Shiv, so far?
No, no, sir.
Textile business, no clients?
No clients. Only construction and schools.
Oh, okay. So usually now when you do audit for textile, this is common we come across. Coming further, there is next concept called job work. Job work under GST law. This job work actually teaches someone who doesn't know the business. We have Section 19, Section 143, Rule 45, which talks about these aspects. Condition restriction respect of inputs, capital goods sent for job work. I'll explain this concept of job work, then we'll go for further activity. There is a person called principal. There is a person called job work. It's a customer. As a student, when we read a few subjects, it teaches us how the business happens. Like quite interesting. Like when we read this income tax, V.K. Singhania, T.N. Manohar and others, multiple things are there we don't know. When we read the book, oh, this is how the business happens. We get interest on the subject. Similarly, job work is one such a provision where it creates how business happens. Like one example, ATM machines, the era of 2000. These days, 1990s, we don't know ATM machines. Now, 2020, again, we don't know ATM machines. There are very few people actually who go to ATM machine to draw money. Do you use ATM? No. Have you used? Used, but not a regular, right? This business of ATM machine, if we try to understand, those days where we go to the bank with a pass sheet, passbook, slip, checkbook, draw money, and then stand in queues. This all the syndrome was broken when ATM business came into India. This ATM business, when they started, the private banks, the ATM machine, what we see typically, this ATM machine is not manufactured from one particular fellow. This is manufactured with different people. This is where this job work, it was there under central excise, but an example where we use. I have a requirement. I define the requirement. This requirements come from my customer saying that, look, I need this dabba. This dabba should have this monitor, should have this keyboard where you enter so and so thing are connected. There's an internet, the cable which gets connected where the money gets dispensed. Now there's a definition of requirement to a principal. Now principal, this fellow who is the main seller, this fellow should have technology. This fellow should have this equipment. This fellow should have the technique. I'll say this is technology, technique. For doing all this. When 2000, when this business model came into picture, let's take one simple example, ICICI Bank. They ordered for, say, 2 lakh ATM machines. Imagine a manufacturer who sits in Hosur, Bomsandra. South India started actually this. Manufacturing 2 lakh is something which is unimaginable. I cannot let go the business. So what they have done, they brought this people called job worker. You have this panel, that digital panel, please give your quotation. You have this switchboards, give your quotation. You have this circuit technology, please give your quotation. You have this box, the dabba, which you see, manufacturing, give your quotation. Finally, the IT company who gives the tech platform. I have a conglomerate of 4-5 people coming together to manufacture this particular ATM machine. And there will not be one sole fellow who does this together. There's a dependency of 4-5 people. Like A doesn't know what B will do. B doesn't know what C do. D, E kind of thing. I bring all in bits and pieces. Then I do in my warehouse called plugging, and where this ATM gets delivered to ICICI. And they gave this requirement. RBI also said, let one fellow not do this. Like when we have this currency printing and all. Nothing comes from one particular source. I have various sources where that fellow doesn't know where is this source. This is where the secrecy comes into picture. So this job worker is a fellow who works, who work or process, which is called intermediate process on goods. These goods belong to a principal. These goods belong to a principal. Let's look at this definition of job work, which is defined in your GST law. Job work means treatment or process which is undertaken by a person on goods belonging to another registered person, and expression job worker shall be considered accordingly. Very simple definition. Manufacture, they have given little more elaborative. They say there's a treatment, there's a process. The treatment or process is done by a person on goods belonging to another registered person. And the expression job worker shall be construed accordingly. This is what job work brought in the person called job worker. So in simple, what we need to understand from here is this treatment or process. So ingredients, there is a treatment, there is a process. This treatment or process which is undertaken on goods belonging, very important, to whom? To another registered person. And the person job worker shall be construed accordingly. They brought in job work as a person who does this process will be considered accordingly. This is what they say. Now, let's take this example of this, what you call ATM machine. Let's say that there's a company called XYZ Limited. XYZ Limited, who is there in Karnataka. Who is there in Karnataka. Now he has got process called, one is that box, the ATM outside box, what you see. Second, you have your control panel. Then you have this display. Let's assume only these three are done outside. Rest all is done inside. This box is manufactured in, say, Tamil Nadu. Control panel is manufactured in, say, Andhra Pradesh. Display is done in, say, Maharashtra. Now, this fellow is registered in Karnataka. This boxes, you have steel. Steel comes from, say, seller who is there in, let me plot my seller here. Seller is there in, say, Maharashtra. Control panel, say the control panels are like electrical equipments which are there from Tamil Nadu. Display, say this is imported. Now, these are my inputs which are required for my manufacture. Now, look at the business model. Can I get steel directly from Maharashtra to Karnataka? I bring, again I send it to my job worker. My process of transportation, accounting in the warehouse, accounting over there becomes a tedious job. So instruction, bill to Karnataka, ship to Tamil Nadu. Similarly, Tamil Nadu fellow, bill to Karnataka, ship to AP. Import, I import in my name, but I give a delivery directly in Maharashtra. This is what is going to happen. Now, where your section 16, subsection 2, clause B. You remember input tax, 5 conditions? I should have a tax invoice. I should have received the goods and services. Now, this is a violation which they have brought an exclusion. Now, they say that since job worker received the goods on behalf of principal, the day the job worker received the goods, it is deeming fiction. Deeming fiction that the goods are received by the principal manufacturer. I call him as a principal. Principal manufacturer. So the day the goods are received by the job worker, it is deemed that the goods are received by the principal. So job worker received on 5th April, I account on 5th April. This is where the deeming fiction comes into picture. Though physically goods are not coming to my site, it goes to the site of my job worker. Now, in construction, we use this job work by and large, or I would say construction site. Now, if you imagine this construction site, Assuming this is my corporate office, register office. My site 1, site 2, site 3. Let's assume that I buy steel from Jindal Steels. I buy 500 metric ton. This 500 metric ton doesn't come to my store head office directly. Rather, 100 will go here, 200 will go here, balance 200 will go here. Similarly, let's take example of cement. Cement, I get truck load. Say 10 trucks have come. Out of 10 trucks, 5 trucks will be going here, 3 trucks will be going here, 2 trucks will be going here. We have this model called build to ship to. So this is the case where the violation of 16(2)(b, they say that though goods are not received by head office, the goods went to the site directly. It is deemed that there is a deeming fiction that whoever is the principal have received such goods or services. This is what we need to keep in mind. Shiv, any doubts?
No, sir.
No, sir, no.
Here, we were talking about job worker where there's a principal, there's a job worker, right? Now, law says that, look, when you operate like this, could be in construction, could be in job work, whatever it is there, look at your principal, look at your job worker. Scenario 1, principal is registered, job work is also registered. Scenario 2, principal is registered, job worker is unregistered. Scenario 3, principal is unregistered, job worker is unregistered. Scenario 4, job worker is unregistered, principal is unregistered, job worker is registered. These are the permutations and combinations. What is expected from section 143? They say that when both the people are registered, there is no complaints for such kind of bill to ship to. Because job work is also registered, principal is also registered, goods can travel directly to a job worker. There's nothing to worry. Second scenario, since job worker is unregistered, principal, I'll say principal, has to add additional place of business of the job worker. I repeat, the law is expecting that when your material is going to a job worker, because your job work is not registered under GST law, you add this place of job worker as your additional place of business. This is what the law is expecting principal to do. What could be the logic if you ask the complaints? When I do audit of your books of accounts, like when I do physical verification of your inventory, you'll say, so my store in my factory has got this much component. The balance component is a job worker. Since job worker is not registered under GST, how do I know which jurisdiction? I don't know. Because that fellow is unregistered, you bring him into your additional place of business. The accountability, maintenance of books of accounts. If your job worker is registered, when I visit the job worker premises, books of accounts are maintained for inventory. So I'll get to know over there. Because he's not registered, he don't maintain books of accounts. I put the responsibility on the principal. So you add that job worker's premises as additional place of business. Now for scenario 2, if at all, if job worker, I'll put it here this way. For scenario 2, principal, job worker. Let's assume again scenario 1. Principal is in state 1, job worker in state 1. Scenario 2, principal in state 1, job worker is in state 2. I can add additional place of business in this scenario. Both are in Karnataka, both are in Tamil Nadu. One fellow is in Karnataka, another fellow is in Tamil Nadu. I cannot add this additional place of business. Please keep in mind, when I want to add additional place of business, if both the people are in the same state, I can add. Sir, I am in Karnataka, my job worker is in Tamil Nadu. Sorry, I cannot allow to add Tamil Nadu as your additional place of business. So here, my job worker mandatorily needs to get registered for me to send my goods. If job worker says, sir, small time fellow, I don't want to complain to the law, Then for this scenario, if job worker is not willing to register, then mandatorily this principal has to obtain registration state 2. Because job worker is not registered, after obtaining my registration state 2, I'll add additional place of business of job worker. Like there are people, we have this battery, used battery in, there's a place called Chikkatirupati. What is that place? Malur. Malur. In Karnataka, there's a place called Malur where there's one big unit who does a job work. What does he do? The old used battery. Whatever old used battery is there, it travels to Malur, a big unit, unregistered, scrap fellow. He breaks this plastic battery. He takes the lithium out of that. Plastic is segregated, lithium is segregated. He sends back to the principal. Now they ensure that they don't register under GST. Once I'm touching 20 lakhs, like A transfers to B, B transfers to C, they never get registered under GST. And every month they were doing that. A point in time, they decided that it is not going to happen. Then finally they got registered under GST. There, when we talk about lithium, the chemical which is very, very hazardous. If lithium goes into the human blood, then cancer. They're prone to cancer. So, like we have this Excite batteries, Amar Raja batteries, where they ensure that a employee, when he comes to the factory, he comes with his normal dress, uniform. Within the factory, they give a different uniform. That uniform is washed, ironed, and kept for the employee. After the job, they leave that uniform, they put their own dress, they go back to the home. They ensure that you take a bath, you wash your body completely, because lithium should not travel to your residence out of the factory. So much particular there. So those are the cases where not everyone does this job work. The job work is not registered for various reasons. So where principal is interested in job work, he gets registered and adds that as an additional place of business. Now this is your scenario number 2.
Additional place of business of the job worker in the state.
In the state. Now, assuming I'm in Pinia, my job worker is in Dodbalapur. I add that Dodbalapur premises as my additional place of business. So I get into an agreement saying that you are my job worker. I say, please give me your permission to add your premises as additional place of business. On the basis of your Aadhaar card, your electricity bill, your property tax, I take those documents and add as my additional place of business. Reason, lawmaker wants to control and track those places where your material is stored without registration. Scenario number 3. Scenario number 3. If this is in state 1, job work is also state 1, this business model is allowed. If you're, I'll put it this way. Scenario 3, the principal, job worker. Scenario 3, both are unregistered. Both are unregistered. Principal is in state 1, job worker is in state 1, permission for job work, they allow this model, no approval is required. Principal is in state 1, job worker is in state 2. They say, I won't allow this kind of business. Because the goods are going out, there may be a registration which is required. Now there you look at your 20 lakh turnover. Since it is less than 20 lakh, if the goods are supplied from this particular place, then mandatory registration for your principal. Now, after the job work is done, I'll not bring back the goods. I'll sell from that particular state. Their law says that nothing doing. Boss, you register yourself and you add this as your additional place of business. That means to say eventually in state 2, I'll be registered. Once I'm registered in state 2, state 1 also I'll get registered. So if you look at in India, we look at this combinations as combination. When law says this, we discover these two. Eventually, to save money, we get into this business model. But indirectly, lawmaker is also buddhi. He knows how to control the people who are not getting into the ambit of your taxation. When you look at this TCS, what they have brought in, whatever we think, innovative ideas, they try to cover with TDS and TCS. Like example, old used jewelry. I go to the jewelry shop, I give my old jewelry, I draw money from the jewelry shop fellow. More than 2 lakhs, I believe PAN number is compulsory. Now, what we do, if 5 lakhs is jewelry, day 1, 2 lakhs, day 2, 2 lakhs, day 3, 1 lakh. The same fellow. We split the transaction. You have cash transactions. If you pay more than 10 lakhs, rule 60D, 10,000 cash. 20,000 or 10,000 cash.
20,000.
20,000. So if it is more than 20,000, they say it is an ineligible expense. So what I do, split 5,000, 5,000, 8,000, 8,000, and then we split the vouchers to get into the business thing. So when lawmaker makes a law, we see how to break the law. Coming back, scenario 3, eventually I get registered because of the business model. Scenario 4, because
under scenario 3.
Scenario 3.
You said once you get the 20 lakhs turnover.
You have to mandate register.
Again, goods are supplied from job work to the principal. If that crosses 20 lakhs, then only registrations are.
If goods are supplied, interstate supply.
But the supply.
I'll mention this. There is an interstate supply.
Yes.
And there is a mandatory provision called Section 24, compulsory registration.
Yes.
Irrespective of turnover. Irrespective of turnover, if you make a supply, then you have to get registered. So here, job worker is supplying to principal or principal supplying from the job worker premises to any customer. Eventually, both of them get into the registration. Look at the complexity. You try to break the law and get into this business model because let's put it this way. I'll make it a little more easier. Say this scenario 3, I'll put it this way. Scenario 3, principal, job worker. I'll call situation 1. Principal is in Karnataka. Job worker is in Tamil Nadu. Say buyer is in Andhra Pradesh. Now, Karnataka, when the job work premises job work is over, instead of bringing the goods back to Karnataka, I'll not do this. I'll say, boss, supply to this fellow. The moment this is done from Karnataka, I am billing to Andhra Pradesh. Interstate supply. When interstate supply, Section 24 comes into picture, compulsory registration. This is from principal point of view. Job worker billing to principal. If he is billing as goods, then again, he is also, Section 24 gets compliant, he has to register. If it is services, for services up to rupees 20 lakh, he has a threshold limit not to register. So job worker is protected up to rupees 20 lakh in case of services. In case of goods, no such exemption. Even 10 rupees, 100 rupees, he has to register. So where job worker is registered, principal is also registered. This is how law is working. So it's like our Chakravyuha.
So
any doubt?
When registration is taken for the job workers, still we can do the work, right?
Straight we can do
the job worker.
Coming in, Mohan.
No, the job worker don't want to get registered in the GST, and the principal also not will that place in the additional place of business. But still, we want to say for repairing or reconditioning, whatever it may be.
No. Without adding additional place of business, it is not permissible. We have to mandatorily add additional place of business.
Okay, so at any chance, without adding this under registration of GST purview, this job work can be done with the job worker.
See what will happen.
Threshold limit is very low.
I'll give the condition. Section 35. Yes. There's Rule 56. which talks about maintenance of inventory register.
Okay.
Now, assuming that you bought this 100 metric ton steel, na? In your inventory, like this is your factory, this is your job worker, this is your site. Assuming factory, you have 10 metric ton, you have a job worker 80 metric ton, balance metric ton you have here. Now, if you don't add this as your additional place of business, if you don't add this as your additional place of business, you know, the provision says that deemed to be supplied. Deemed to be supplied. That means to say this 90 metric ton, though it is in your inventory, though you have not billed to your customer, law says that it is deemed to be supplied, pay GST on this goods. Is it worth to pay GST or is it worth to add this is an additional place of business?
Okay.
Clear, Naman?
Clear.
Shiv, one important point from construction point of view, these sites which I was giving example, no, Shiv?
Yeah.
Most of the time, you'll have this main as your principal place of business. These sites, no, they never add these sites as additional place of business. If you check your bills, bill to your head office, ship to your site. Now, if this site address is not registered, no, Shiv, as additional place of business, the benefit of section 16, subsection 2, clause B, input tax. This is substantial benefit which is questionable. Clear, no, Shiv?
Yes.
In construction, this is one perennial issue. They don't add. Reason they don't get approval or they don't know the law. There are a lot of violations in this aspect. Now, scenario 4, unregistered and registered. Now, because one fellow is registered, if both are in same state, nothing to worry. If one fellow is in another state, mandatory against section 24 comes into picture, eventually principal also will get registered under GST law. Now, law says that, look, in case of inputs, in case of capital goods which are by way of mold, jigs, die. They say that goods which are sent for job work, the time limit is 1 year, either to bring back or to supply. Law says that from principal, it went to the job work. I'll give you a time limit of 1 year, you bring it back or you supply from the job worker premises. In case of capital goods, they have given time limit of 3 years. They have given time limit of 3 years. For what? Either to bring back or supply. In case of mold, jigs, dies, no time limit. No such time limit. Now this mold, jig, die. Now these are like, no, we say achu. No, that's the impression which gets created. Like say Maruti, Hero and all. When I want to manufacture a particular commodity, I need a particular shape. Like let's look at the car. The car has this bumper, the tail lamp. No, that shape, the design comes using a particular mold. These molds are supplied by the principal to the job worker to use in manufacture. And this shelf life of this mold, jigs and dies is 10 to 20 years. 10 to 20 years is the life. Because of the shelf life, law says that I don't have any time limit for these molds, jigs and dies, but only in case of inputs, 1 year, in case of capital goods, 3 years. What do? You bring back or you supply from the job worker premises. If you don't supply, if I default, there is a deeming provision. Deemed to be supplied by the principal on the day goods are received. Goods are received by the job worker. The day goods went to the job worker premises, that is the day I deem that the goods have supplied. The impact of this, the tax I have to pay along with interest. Reason, assuming 1 year is over, government didn't got money for 1 year. So that entire 1 year interest has to be paid back. This is a provision. Commissioner may allow this time limit of 1 year by another 1 year, the 3 years by another 2 years. In case if there is an approval from commissioner because of various reasons, additional 1 year, additional 2 years for capital goods. This is what provisions say. And there is a permission. There is a permission which needs to be taken. The permission earlier was manual. Earlier, it was under manual. Under GST law, this is automatic. How automatic? By filing ITC4. By filing a statement called ITC04. This I would say as a statement, as a written, which needs to be filed. This is a statement to be filed when there is a material which is sent for job work. Now there is a periodicity. They say that any registered person whose aggregate turnover in the preceding financial year, is more than 5 crore, then every 6 months I need to file this ITC04. April to September, 25th October. October to March, 25th April. 25th of the subsequent month to the quarter of year. In case less than 5 crore, then annually. Annually, I need to file this ITC04. So this is a deeming provision approval, which is automatic when I file ITC4. This is just an information. How much material I have sent to A, B, C, how much I received back A, B, C, or how much I have supplied from A, B, C. This is what I indicate in this ITC04. And scrap. In case if there is any scrap which is generated, job worker or principal has to pay GST on such scrap. Because it's a manufacture, it's a process. Like example, say cutting, bending. I cut the steel, like one sheet I cut, the edges, whatever extra small pieces are there, that I sell as a scrap, either job worker will sell or principal has to sell. This is what section 143, section 19, rule 45 talks about. Any doubts?
When it comes to say, paying GST on scrap, so if that situation happens, either of them or both of them have to be registered to GST. Even though
yes.
are,
Anyone has to register under GST. Yes.
Initially both are registered also. When the scrap scale comes into the picture, assuming regular 20 lakhs
limit is there, then 20 lakhs limit is there. If both are within the state, less than 20 lakhs, nothing to worry. If anyone is more than 20 lakhs, then
have an option but to go for it.
Yes. We'll go further, Mohan and Shiv.
Yes, sir. Yes, sir.
Now, the last concept for the day, ISD, Input Service Distributor. Input Service Distributor, ISD. Section 20 talks about ISD, Rule 39. Section 20, Rule 39 talks about ISD concept. Very simple, not that complicated, but again, the way business goes on, this becomes complicated depending on the nature of business. Let's take example. There's a company. This company is into manufacturing, trading, service. Like a classic example, let's take example of a Maruti. In costing, we have one chapter called transfer of cost, like, interdepartmental costing. In costing, when we study, there is a dependency of one department on another department. We call interdepartmental costing. Manufacturing of this goods from Maruti will be supplied through trading division. The goods which are sold, service is given by this division. Now, we do profitability of manufacturing division, trading division, service division. Which department, like no departmental manager, who is doing good, who is not doing good, management takes a call. All that is a subject we studied. So here, now this is a classic example where without manufacture, I cannot do trading. Without trading, I cannot give service. Without a proper service, trading will not happen. Without proper service, without trading, manufacture will not happen. Now this is interdependency on my business. Let's take example of this business model where, so there is a travel. When I do travel, I have what you call airfare or train. And eventually, I have accommodation. I have, say, advertisement. I have rent. I have information technology. That is your software license, your hardware, anything of that sort. Then I have audit consultation. Kind of. Now, in case of Maruti, say manufacture happens in 2 states. The sales happen in say 10 states. Service happens in say 28 states. This is a kind of business model we can think of. Now, for this entire business, let's assume annually, only I'm talking about GST point of view, not the expense point of view. I spend on e-travel, etc., 2 crore. Accommodation, say 5 crore. Advertisement, 10 crore. Rent, maybe another 2 crore, or I'll say 20 crore. Information technology, 5 crores. Audit and consultation, maybe say 1 crore. Now, this is a volume of input tax credit. Question comes, where should the benefit of that particular input tax credit? The business is not that simple. When we talk about e-travel, I'll have IGST, I have CGST, I have SGST. Also, I may have UTGST also. Few union territories. So when a seller, like now this model, when I'm talking, I'm registered in, like when I talk about registration, state 1, state 2, so on till state 28. A simple example. So there is a statutory auditor. The statutory auditor is in, say, Tamil Nadu. The company's head office is in, say, Maharashtra. From Tamil Nadu, when he bills to the head office, he will bill as IGST. But the unit which is there in Tamil Nadu, if at all this Tamil Nadu auditor bills to Tamil Nadu, he will bill as state GST, central GST. This is a kind of complexity you have. So to keep addressing these issues, they say, first and foremost, they say, identify the corporate office. Identify the corporate office. They say, obtain ISD registration at such office. They call such office. That corporate office is going to be your such office. Then, step 3. Let suppliers bill using GST of ISD. They say, whoever, we were talking about these examples, right? The hotel accommodation, advertisement, rent, etc., etc., etc. Let them bill using the GST of ISD. Step 4. Pay reverse charge mechanism, if any, through regular GST and transfer such GST to ISD by cross charge. Law says that there could be reverse charge mechanism, could be for your free transportation, could be for import of service. Sir, I have imported Microsoft license. When I imported, I need to pay tax under reverse charge. So they say you pay through regular GST by cross charge transferred to ISD because that's the common office. Once you do that, step 5, transfer the ITC from ISD to regular GSTN. Transfer input tax credit for that month, whatever you receive, from ISD to the other GST number. Step 6. Use the turnover ratio. Use the turnover ratio of previous financial year. Use the turnover ratio of previous year. That means to say, if you have 28 states, like no, state 1 divided by aggregate turnover into ISD credit. This is a like all 28 states, whatever turnover is there, that will be denominator. Whatever particular state is there, that will be your numerator. State 1, state 2, state 3, I'll get a proportionate. That I apply on the, when I say ISD, IGST, CGST, SGST separately. This is what I have to apply. Losses. So what if in the previous financial year, not all units are existing? Like example 1, previous year, current year. So previous year I have 28 states, current year also 28 states. Don't worry. Whatever ratio is there for the previous year, use that ratio. Example 2. So previous year, there are 25 states. Current year, there are 28 states. Then they say, don't use previous year ratio. Rather, use a quarter preceding the month where such turnover of all 28 states exist. Like to say month 1, month 2, month 3, month 4, month 5, month 6. So month 1, I have 25 states. Month 2, 25 states. Month 3, 28 states. 28 states. 28 states. Now this becomes, in month 6, I have 3 consecutive months, I have the 28 states. Use this turnover for the purpose of distributing for month 6. Month 3, month 4, month 5, what I will do? I'll use this 25 states. Whatever 25 states turnover is there, I use it for month 3, month 4, month 5. This is what they ask us to use for the purpose of transferring the credit. Now, little further, they say, what if ISD is in state 1, the recipient could be in state 1, recipient could be in state 2. How do I distribute the credit? Now, if recipient in state 1, recipient is in state 2, how do I distribute the credit? Let's assume that ISD has received IGST credit. IGST, like there is a statutory auditor who built IGST. Now, example 1, where ISD recipient. If ISD is in state 1, recipient is in state 1. Result. Choice, you can transfer as IGST. Why? Because I have received IGST, I'll transfer as IGST only. ISD is in state 1, recipient is in state 2. Even then, I'll transfer as IGST. I got the input tax credit as IGST. Though my recipient is in state 1, I'll transfer as IGST only. No confusion? Concept is IGST is like IGST. So I don't want to break. It's like a joker card. IGST can use it for CGST, SGST payment. So they don't want to disturb that IGST. Example 2. My ISD has received CGST, SGST. If ISD is in state 1, recipient is in state 1, distribute as C plus S. Because you received C and S, na? Give it to your state 1 as C and S. My ISD is in state 1, recipient is in state 2. Add C plus S and transfer as IGST. Whatever value of C plus S is there, transfer to the state 2 as IGST. So here, what we need to keep in mind is, now this is a table when we file, there's a return called GSTR 6. GSTR 6. When I file GSTR 6, there is a table where this distribution is automatic. The moment I have the state, the recipient is other than state, automatically the C and S gets transferred as IGST. But this we need to do math in Excel, then we need to fill this particular form online. This GSTR 6 is a monthly return. This is a monthly return for distribution to be filed on or before 13th. 13th of subsequent month, I need to file this GSTR 6. This is the concept of input service distributor. Company.
This has to be filed by all service providers.
Yes, ma'am. Like first and foremost, look at the business model. Do we have these common credits? Answer, yes, I have common credits. Do you have registration in more than one state? Answer is yes. Now question comes, do you want to enjoy this credit or do you want to forego? If you want to enjoy, get ISD registration. If you don't want this common credit, no ISD is required. So I'm registered only in Karnataka. Concept of ISD is not required. I'm registered in Karnataka, Andhra, Telangana, Tamil Nadu, Maharashtra, and Delhi, where I have these common credits. I want to receive, then get into ISD. People will say, sir, ISD is not required. Let me have individual states like A travel. Because I'm traveling from Maharashtra to Tamil Nadu, I use Tamil Nadu GST number. Now question comes here. This input tax credit, is it entity level input tax credit or state level input tax credit? Now, how do you justify? Now you have like managing director, or the VP finance, VP marketing, the key management people. Now, when these people travel, the benefit is to the company or the benefit is to the state? Definitely it is not to the unit. Now, this is where ISD registration comes into compulsory. If I've enjoyed entire credit in Tamil Nadu or Maharashtra, that particular state officer will say, why should the credit be enjoyed in Maharashtra? Why should not be enjoyed by other states? So there, can I do a cross charge? The question came, sir, instead of ISD, can we do cross charge? Whatever formula you have given, the previous year turnover we were talking now, this cross charge, can I do instead of ISD? Answer is yes, till 31st March 2025. No from 1st April 2025. ISD was optional. There is circular 199 where they say, because this section 20 is not compulsory, till 31st March 2025, cross charge was allowed. But from 1st April 2025, ISD is mandatory. So from 1st April 25 this year, I have to mandatory register ISD, get all those common benefits, whatever we have identified the list. Like for example, these credits should have been flown to ISD GST number. From ISD GST number, I need to distribute through GSTR 6. So this is what the law says. So you want the benefit? Get registered ISD. You don't want the benefit, you put it to your P&L. None of the companies want to leave this credit because substantial, like 15-20 lakhs bare minimum they get, which is good enough to pay one departmental cost salary. So they don't want to lose this particular benefit. Only thing, I have to register, use that turnover formula and distribute to the other states. So this is the last topic for our today's discussion. Any doubts
Questions?
before we wind? Yes. Sure.
Sir, if you don't get registered, will that
Ah.
audit fees CGST or SGST paid? Will that be,
Huh.
has to be reversed?
Yes, sure. Like, because I said no, refer to this circular 199 till 31st March 2025. Circular said because it is not compulsory, mandatory under law, they say I can do a cross charge. So that statutory audit from head office, if I cross charge to another state, it was allowed. From 1st April, no, it is not allowed. Did I answer your question?
Yes, yes. In our case, one of the client, we have not yet got registered for ISD, but the audit fees bill we have already done this year to the normal GST itself.
Then we have to amend that particular B2B transaction. Once I amend now, from regular, it will go to the ISD number. From ISD number, they need to transfer to the other units. So check with your client. Is he okay with your B2B reporting, or do you need to change that? Based on that, you can take a call, Shiv.
Okay, thank you.
Right? I'll take one more minute before we wind up. Couple of case laws are there which I am not touched upon. Like the landmark judgments where they say that input tax benefit is not a fundamental right. This is a right subject to terms and conditions. So there is Mafatlal a judgment under Supreme Court, one landmark under central excise era. You want to enjoy the benefit of input tax credit, you enjoy. Because there are conditions attached to that. If you don't fulfill those conditions, it is not a substantial right. Similarly, under GST era, Suncraft Energies, one Kolkata judgment, which was in favor of the assessee from the Supreme Court also, GSTR 3B, GSTR 2B. Only vendor has reported in his GSTR 2B, can I enjoy the credit, or otherwise can I enjoy the credit? The High Court said that, look, find out your supplier. If the supplier is default, can you recover that money from supplier? The government, first, instead of coming to the purchaser, let them go to the seller. Seller is existing, seller is doing his business. If seller can pay that money, don't recover from buyer. If seller is absconding, those exceptional cases come and catch hold of the buyer to reverse the input tax credit. So there are a couple of judgments which will help you to understand this input tax credit. I'll summarize the judgment, those points which we need to take, like another Ecom Gill, which was under VAT era. In Ecom Gill, there was one provision called under GST, section 155, burden of proof. Burden of proof. This Ecom Gill case also comes with this backdrop saying that, look, you have to prove that you have enjoyed this, you have to enjoy this input tax credit. You purchased the goods, you have received the goods, you have a tax invoice, you made the payment to your seller. To prove that goods have been received, there is an e-way bill, there is an e-invoice. Prove that the goods movement happened. Now, how do I prove e-way bill is compulsory? So what if e-way bill was not done by my seller? I say, till my factory, the delivery is the burden of my seller. Even in the construction show, you can think of this judgment. the steel, cement, sands delivered to the site. Sitting at my factory, how do you monitor? After 2, 3 years, when I come for the audit, how do I know that the material got delivered at your site, at the job worker? Was there any transport bill? Did you pay any reverse charge mechanism? The LR copy, the transport bill, was that attached to this particular goods invoice? So these are the burden which was put on the buyer to prove that you are entitled for that input tax credit. So, no, nut and shell, to conclude, just because I have a tax invoice, just because I pay to the supplier, just because he filed his GSTR 1, it came into GSTR 2B. This is not a substantive evidence to me to prove that I'm eligible for input tax credit. Now, if I'm a manufacturer, does my P&L account showcase so much of production happened, like power consumption, labor consumption? What is your input? What is your process? What is your sale? What is your closing stock? You substantiate with your factual data that so-and-so activity happened where you are entitled for your input tax credit. You remember that abnormal loss? When I manufacture, when there is an abnormal loss, goods lost, stolen, destroyed, write off. When I have written off my raw material, I'm supposed to reverse my input tax credit. So these are the principles which I need to keep in mind when I say, sir, I'm eligible for input tax credit. Clear? So with this, I conclude my today's discussion. We will meet up in couple of other sessions other than input tax, maybe valuation, maybe registration. We'll come with one more topic where we'll have a detailed discussions on understanding the GST provisions. Till then, see you all. Happy learning. Any doubts, you can message me. I'll be there to clarify once again. Okay? See you all.
Thank you, sir. Thank you.
Bye.
Yes, sir.
Bye.
Thank you, sir.